East Coast. It's been a crazy day already for me, so don't mind that I start mixing up my coasts. My name is Michael Filighera, and I am with LogicalSignals.com and also TradersHelpingTraders.com. And my presentation today for this wonderful event is using Elliott Wave and Fibonacci in 2023. And how I want to do my presentation here is to kind of put some info together to how I make Elliott Wave and Fibonacci work over a longer period of time. And it's going to sound weird because if many of you have been following me on YouTube, you already know that I'm a day trader. But just giving you a little quick history on me, I am an ex-market maker, an options market maker, and I traded here on the Pacific Exchange here in San Francisco. I've also traded on the London Traded Options Market and the European Options Exchange in Amsterdam. And I got my introduction into electronic trading via the DTB, which is the German bourse. But also I traded in Amsterdam. And then, of course, the German bourse is located in Frankfurt. So that was my introduction to electronic trading. I came back to the United States, went back to the Pacific, and continued to trade. So that would be in the late 90s and the rollover and the dot-com crash. After that, things really got slow and everybody was leaving the floor, and the floors just really weren't becoming as important as they were for trading. And so I left the floor, set up myself in my home office, and continued to trade. But as the volatility got a little bit out of hand, as everything went electronic. So we have to understand it's like trading is now quantitative, and which is nothing more than saying it's all computerized. So all of our orders, everything we do is all computerized. We receive everything via the internet. So we're algorithmically controlled. And so with all that trading going algorithmic, it just kind of took away from the floors. No need to have a broker represent your order in a crowd of people. The crowd's diminished. I left the floor, but then the volatility really started to kick up. And again, it's not the same way that we look at volatility now. I mean, we look at volatility now as it's the speed of how something is going to move, and usually higher volatility is associated with the market that's going down. Well, the one thing that I've noticed is that even though that is how that VIX index is calculated, and that's going to be via the puts and calls on the SPX, that's how they come up with the volatility, by measuring the put and calls and the volume of trading, and also the volatility at how fast things are moving. So the volatility when you're trading the futures market is, if we're seeing that the volatility right now, 24, that's where it's going to close today. You can see it's like, wow, gee, shouldn't it be higher? Shouldn't it be lower? But you can see they're just going to kind of sell it a little bit right now. No matter what, the volatility within the futures market that you may or may not be trading is going to be just as fast. If it's going to go up fast, the next move down could be just as fast, and et cetera. So if you're doing intraday trading. So I think the volatility becomes a very big part. And I was really kind of done with the overnight volatility that would kind of come into the market. And when you're still a floor trader, you can't trade until the floor reopens. But even at that point, options did not trade 24/7, as they still actually don't. So options positions, bell rings, you get a few minutes to make your adjustments, and then it's done, and you don't get another shot at it until the next morning when the market reopens. And that's the way it is even today. So you can get stuck in a lot of positions as things happen. Good example, last Thursday. I have yet to meet somebody that actually said, oh yeah, I was waiting for that big of a move off of that number, off of that data that was released. CPI data last Thursday. I've yet to, and I know a lot of traders. So that presented a whole different scenario to anybody that's doing analysis. But I want to share with you what scenario it did not change. And that's my Elliott wave view of the markets. So just to kind of give a quick overview of Elliott wave. Elliott wave, of course, is a product of the work of R.N. Elliott, a real person, lived in the 20s and 30s. I believe he passed away in the late 40s. But he had some medical problems in the late 30s. And so he came out here to California because I guess they had issues with his lungs. And so he was convalescing, but he started to really follow the market and chart. He charted the market. And so then, you know, you had to go and you go to a ticker tape and you had to pick the prices of all these different stocks, or of the Dow Jones index, which was the active index at that time. The S&P index did exist, but it was the Dow that everyone followed and did their measurements of market activity against. But R.N. Elliott started to produce his charts, and he realized that there were very discernible patterns that seemed to be repeating. So he started to notate a lot of these things. And then he started to realize what was going on in the market that was helping to produce some of these. And then we started to get more of that. What Elliott wave really does measure is the human emotional responses to what's happening in the market. So it becomes predictive in the manner of that Elliott put together what the patterns were and what to expect once that pattern is complete, what we would look at coming next. So again, the way Elliott works is that there's two basic structures that we look at. One is an impulse, and we label that numbers 1, 2, 3, 4, 5. An impulse move, either up or down, an impulse move will consist of 5 waves. 1, 2, 3, 4, 5. Wave 2 corrects wave 1. Wave 4 corrects wave 3. And then once it all completes doing the 5, then the market will do a little bit larger 3-wave corrective phase, which is labeled ABC. So that's the basic. So we get 5 waves down, we got 3 waves up. Then we scale out to realize what they are going to be. So there are degrees that we have inside of all of these. And it's those degrees that build. So the basic premise of Elliott wave is that it is building blocks. So no matter if I'm looking at my weekly chart or if I'm looking at my 5-minute chart, we will be able to continue to see these patterns of 1, 2, 3, 4, 5. So I can go down to a 1-minute chart and we will see these patterns. Well, we came off of that high. What do we do? 1, 2, 3, 4, 5. So we did, here was the top, a 1, 2, and then we got a beautifully extended third, 1, 2, 3, 4, 5. And that's a 4, so maybe we need to come down one more, it would seem. So you continue to see the patterns, and I'm on a 1-minute chart, and I can go to my monthly maximum chart, and again, we have the patterns. We continue to see. Now this one goes all the way back. This is the future, and I can go over one better and go over to the SPX, and that goes all the way back to 1928. So that's a lot of data, which is why it looks all scrunched together like that, because I have to tell you, right in somewhere back in there, we got the crash of 29, but you can't even see it because it's so, there it is. But when I pull it out and I got to show all the years of data, it's one big flat line, but that's the crash. So of 29. Now, when you have that much data, I can put together where I believe the market has come from, what it has completed, and what comes next. So understanding as well that Elliott wave comes in degrees. So if you think about the building blocks, if I start here on a sub-minute, those are pretty small, of which I don't really have any on this big long-term chart. So even if I go I have to start even higher, but the sub-minute then produces the minute, produces the minor, produces the intermediate, which are the yellow, and then the primary, which are green. And remember, the corrections are counted letters, and the impulses are 1, 2, 3, 4, 5. Then we have a cycle, which is the brick red, and then I have a super cycle, which is the sky blue. So to give you a quick, actually, it's not as complicated as you think, but I appreciate that because I think when it's first laid out, it can be very complicated. But I'm just trying to give you the basics. So what my count is right now, remember, the highest oil count is a super cycle degree. If I go back to that monthly chart, the monthly maximum chart, super cycle wave 2 completed at that crash low in 1932. And then the super cycle degree third wave here in the S&P completed up here at the high, which was in January of this year. So basically 90 years. 90 years it took to complete this super cycle wave 3. That's what we are now correcting, is that super cycle wave 3. Other things that Elliott put in there for us. He gave us tons of information about what to expect and where a corrective wave will find its support to complete. So yes, there's a lot of information that I could be spelling out, but on a log scale, I believe that actually was a log scale. That's how much data is being crunched into this poor little screen. So if I change it to log, it is log scale already. It's just a lot of data and there's a lot of movement. But what I'm now counting, what I am now looking at, again, I'll start back here on this weekly chart. Again, this is the SPX, but I'll go over to the S&P because that's the futures market and that's what most of us are trading in terms of, if we're using the spiders or whatever, it's all based on the S&P future. And here I have that super cycle wave 3, the cycle 5, the primary 5, the intermediate 5, right? They all completed in January of 2022. So we've actually been correcting for 11 months now, going on hopefully a year. The correction will still be in advance. It's not even close in my mind to being over. But what now we have to do is work backwards, right? We construct it by the, understanding that what is inside these waves. So in other words, what would be inside a super cycle third wave? 5 waves of cycle degree that unfolded from 1932 all the way up to this 5th wave, which actually began in 2009. Actually, yeah, I think it was 2009. If I go all the way back, I got to go out to the monthly chart. Right there, that's the 2009 low. So there we have the economic meltdown, and that is super cycle, not super cycle, excuse me, cycle wave 4. And there is cycle wave 5. Now, what's going to be in that cycle wave 5? 5 waves of primary degree. They're labeled in green. 1, 2, 3, 4, and 5. And then what's going to be in the 5th wave or a 5 wave within the primary degree? Each one, there's 5 waves of intermediate degree. Here's the 3rd, which is very clear. 1, 2, 3, 4, 5. And then we have the 4. That was the pandemic. the beginning of the pandemic. So that was our COVID low, which produced a primary fourth wave. And then we had 5 waves of intermediate degree to complete the 5th. And then we had 5 waves of primary degree to complete the 5th of cycle degree. And then we had 5 waves of cycle degree to complete the super cycle wave 3. So what we are producing now, and I'm going to reverse all that for you, is a supercycle fourth wave. Well, what's going to be in that supercycle fourth wave? An ABC structure on a cycle degree. Well, what's going to be in cycle wave A, which would be the first leg down? An ABC structure within on a primary degree. Well, what's going to be in that primary first leg down? An ABC of intermediate degree. So, and we build on that. So we got our first ABC down, intermediate degree, cycle wave A. Then we had intermediate ABC up, and that produced primary wave B. So we're now working on a primary C wave, and that will put in that A wave on the cycle degree. Again, building blocks. So if we try to remember building blocks, yes, right. They're all building blocks. But now when we're working, we need to do it in reverse, basically from the top down, so we can figure out what's all going to take place. Another thing to remember when you're working on a correction of a higher degree like we are, all degrees in the same direction will operate and form the same patterns. So it's a corrective pattern off on a supercycle level. It's going to consist of an ABC of every one of these. And that would be for the A wave. And then we got the B wave. It has an ABC. And then the C wave, and as Elliott had notated, all C waves produce 5 waves. So that's where, once we get our rules down, once we get all that down, now we can build our picture. Now we can take a look. And it becomes confusing for a lot of people because there's a lot of different nuances that come in to what we're doing. But the predictive ability of it is tremendous. And when I combine it with Fibonacci sequences, then it truly becomes useful if we're moving into territory. For example, when we were moving up to new high after new high after new high, people are like, well, how high could it go? And by using Fibonacci relationships between these waves, we could look at and predict where they would start to come in. And I'd have to go back, but I believe 4,800 to 4,850 were there were levels in there. And the fact is that it completed 5 waves up. This is a weekly chart. So every one of these is a week. And it did complete 5 waves up, and in between it all fit and worked. So where are we now? In a very, very strange position. So if we're coming off, I feel that we are still going to be working on a longer term decline. Here's the other factor that Elliott Wave will never be able to tell you: why the market will go in a particular direction. I can tell you my wave count, and my wave count is suggesting that we still have much more downside to do before we're finished correcting that supercycle wave 3. What's going to do it? Well, right now, I can think of many things that'll continue to push the market lower. But we've become very, very short-term and more determined to trade off of them really a narrative that's being spun by financial media, a narrative that may be spun by a technical picture, and the fact that we have an abundance of traders who really kind of come in, and the only thing they know how to do is to buy. You buy and you hold, you buy and you hold. So we're looking for the market to go up. We need the market to go up because that's what we do. We buy and we hold. And maybe they've been holding all the way down and they would like to see the market go up. Now, Let's go back to last Thursday, because that was just beyond. So I'm going to bring this all the way down again. Here we are, primary A, primary B. We're in a primary C wave. What's going to be inside that primary C wave? 5 waves of intermediate degree, right? So what's going to be in that intermediate first wave? 5 waves of minor degree. I got them. There's my yellow one. That signifies intermediate 1, complete. We're in an intermediate second wave. What can I expect to see in intermediate second wave? Well, in minor degree, A, B, C, up. What's going to be in that? So here's the A, here's the B, there's the C. We're still in process. What's that C wave going to consist of? It's a minor C wave. It's going to consist of 5 waves of minute degree, of which 1, 2, maybe 3 is done, maybe 4 and 5 are done. But I'm not calling it. And if you listen to any of my updates, I did record today's before I came on to do this presentation. And I'm not going to say that this ABC is done and intermediate wave 2 is done. Because guess what? We have the potential. What happens if we get another one of these? That was like an incredible move from a market that, in my opinion, was desperate to cover shorts, was desperate to move higher, and not sure why, but it did. And it did on a very fractional, and I mean that sincerely, fractional improvement to the CPI, which gave a hint that inflation was a little bit less. Was it 900 points worth? And I want to tell you, in 1 minute, last Thursday, in 1 minute, the Dow, low to high, in that 1 minute, 900 and I think 50 points in 1 minute. The NASDAQ put in a 508 point turn from low to high in 1 minute. The S&P was over 150. These are crazy, insane reactions. But it was enough to then pull the Dow up a total of 1,200 on the day. The NASDAQ was close to 800 on the day. The S&P was back up over 150 on the day. And then it just continued. So what's to say that we're not going to be able to see that tomorrow? Now, here's the beauty of what Elliott wave can do for you, and also the Danny, I'll get to that in a second, because that would be pretty. Super cycle wave 4 coming in at 343 does not make sense to me. I think what we're going to get in super cycle wave 4 is it'll come back into the 2009 lows is where I think it'll come in. And I'm just going to answer this question, then we're going to go on. Under Elliott, when you're in a 4th wave of this one, we're going to really be working a super cycle 4th wave. Where would I think that super cycle 4th wave will complete? In the price territory of the 4th wave of 1 lesser degree. And that's Elliott's observation. So where is that 4th wave of 1 lesser degree? Right there, right? Super cycle, 1 lesser degree is cycle. There's the cycle 4, there's the low. So 645, 666, or 667, however you want to call it, it would be yes. But I actually think that we're likely going to come in a little bit higher, because the way that he really constructed it was it would find its terminus at that terminus point. But I think it's like what we've learned over all these years is that it's going to be within the price territory of the previous 4th wave of 1 lesser degree. And there it is. So here's the price territory. So I think, yes, that would be a max where it could come in. What's going to cause that? Again, I don't know. So people think you're crazy. It'll never happen. It's like, well, I think a lot of people came in last week thinking that the market would not rally as strongly off of that CPI number, but it did, and it continued. But now what does Elliott tell me? I'm going to show you how it was very predictive and included a bigger, stronger move. Knowing and understanding that I have an A, B, and now I'm looking for completion of a C wave. Let's start adding some Fibonacci, because there are Fibonacci relationships between all these waves, right? If wave 2 corrects wave 1, well, we can put up Fibonacci retracements. Now we can get an idea where wave 2 should come in. Wave 4 corrects wave 3. Well, we can put in, again, retracements. Now we can figure out where wave 4 is going to be. Well, what about wave 5? Well, then we use extensions, Fibonacci extensions. And I run it from here to here to here. Now I have the extensions for where wave 5 may come in. So on that same basis, the first one that I can put in, we're going to put in retracements. Here's wave 1. Wave 1 started there, and it went down to there. So what we have going on now is we have our levels. Today, and now if we're counting a wave 2, using Elliott, using his guidelines, and using what I have also found out over years, and by the way, I've been using Elliott since 1988. And my teachers were Robert Prechter and Dan Ascani. So I don't always agree with Robert Prechter, but he's a dang good teacher and he knows his stuff as far as the basics and the rules and how Elliott works and how the fibs work. And he includes that with, and then he puts on cycle work on top of all of that. So he is very masterful with it. Thank you. So here we are. Minor wave 1, excuse me, intermediate wave 1. We're looking for intermediate wave 2. The most common for a wave 2 is 50% to 62% retracement of that first wave. We got up to that 62% today, went over it, and then just kind of came flying back down. Interesting, because that I'm thinking maybe is only the end of wave 3. If I had to really squeeze out a 4 and a 5, I suppose I could. But this market has to really prove it tomorrow. And that would suggest that that number will be rejected by the market. And that we will, as quickly as we headed up last Thursday, we will now turn and go lower tomorrow. That's what it suggests. I'm not calling that. I'm not saying that's what's going to happen. But if it does, then it just tells me this is done. And now we're starting in an intermediate third wave down. So let me finish this second wave, and then I'm going to tell you about a third wave. So if we've got this second wave coming up to be complete, and I'm feeling that we still have some more room here, well, where's our next resistance level? Well, 70.5% is another one I use. And this actually for the S&P is an old market maker level that was used from the old SPX pit on the Chicago Mercantile Exchange, where all these guys stood in the pits, and this is the numbers that they came up with. So when I'm on the S&P, I continue to use it because it's been valid for a long time. And that's the next level is 40.83 or 40.84, we're going to say. So you got to go plus or minus on that. You know, a little bit of throw over, a little bit under. But what do we have coming in with that? These are 200 period moving averages. The solid magenta is the 200 EMA exponential. And then the dashed line is the SMA, the simple moving average. And they're grouped together from 40.65 to 40.84. Now that's kind of a ringer to me. Now, what can't a wave 2 do? The wave 2 cannot exceed 4327.5. That is the beginning point for this intermediate wave 1 down. So if wave 2 went up above it, well, then it's not a wave 2, is it? Wave 2 corrects wave 1. It can't exceed it and still be considered a correction. So then it becomes something different. So what I have in place right now is the fact that, yep, we can come up there. In fact, we can add a little bit more, and I'm going to add another. I'm going to go down to my 4 hours so I can get a little bit more, because the next one that I can add is we're going to go inside this C wave, And we're going to take a look. If this was the end of, no, it actually would have been there. Actually, I think I have to almost. I got to bring this down. Let me look at my hourly chart. I'm going to have to use that. And then it went up. Okay. So when I'm looking at what I can see coming for a possible fifth wave, if that didn't complete it, well, what can I look for? Well, we're going to be using, excuse me, Fibonacci extensions. So wave 5 is related to wave 3. So if I want to do those extensions on that, then I go from the beginning of wave 3 to the top of wave 3 to the bottom of wave 4. And I got to put it over here, unfortunately. Actually, I'm going to put it here. For whatever reason, I'm going to let that be. Let's call it from what the low we've got so far. Now, the relationship between wave 5 and wave 3. On a Fibonacci basis, the most common would be, believe it or not, wave 5 would be 0.618 of the distance, percent of the distance of that wave 3. Well, that's way up here, 4123. Now, that's a reality. That's a possibility. I cannot say absolutely not, won't do it. What's the next one after that? 100%. That takes us up to 4222. What can't it cross? 4327. So it certainly can get up there. In fact, one of Elliott's and also Prechter's observation is that second waves can and have the potential to retrace almost all of the first wave. In that case, that leaves that open. Now, I'm with you on that, 4078 to 4142. I'm with you, totally with you on that, by the way. So what we have now, you can see now some of that predictive. We can put parameters around this move. Now, mind you, if it goes up above 4327, it's not a wave 2. Then I'm moving back out. And I'll tell you, I already have it, but I've got it on a different chart. I'm going to go over real quick. I have on the SPX chart is where I put together my alternate count. My alternate count is that the primary wave A, which was over here on my other chart, is over here. And that what we're involved in now is a primary B wave. I'm not saying that that's what's in force. It's an alternate view. It's an alternate count. Because if this market decides it's going to just go to the moon tomorrow and go above this level, that level, 4327, well, then it's not a wave 2. And what's the alternate? Is that it's a building up of an intermediate ABC to form primary B. And primary B, we see it right there. Here's its potential. So it has a lot of potential, right? In fact, primary B, and I'm just going to say it, not saying that's what's going to happen. I'm not even suggesting it. But it would have the potential where it could be an irregular B wave and eventually move to new highs. And then still come crashing down in a C wave. These are some of the beauty of Elliott. If we're not going to get ourselves wrapped around, oh my God, it can't do that. It's not going to do that. Absolutely not. But stay open to what is being presented as potential, as possibilities. You now begin to see the predictive nature, good or bad to your position. It's still valuable information because I would rather know what the potential is. So if it started to break these levels, you automatically got some ideas on what's coming next, what this potential of this particular market is. instead of trying to figure out why are they bullish, why are they doing this, why, who's in there, what's going on, et cetera, et cetera, et cetera. I don't care. It's doing it, and I need to be able to trade it. So staying clear of external noise of the who, what, where, when, and how will keep you trading, will keep you knowing where you need to put a stop. If you're willing to trade this overnight and you have a short position because you believe that number is going to drive the market lower again, I'm gonna hope for you that you have a stop in place with whomever you do your executions with. It's sitting there in the market, because I know a lot of people that got caught in that big jump last Thursday that got their head handed to them because they weren't expecting it. And then once it happened, our mental process comes into play after that. Oh, it'll come back. Oh, it'll come down. Oh, it'll do this. And then you're sitting on another 50 points. Then you're sitting on another jump in the market. And the next thing you know, is it, well, no, I don't see that. And there's a couple of things in between. And I don't see that. Look to see if wave 4 overlaps wave 1 on any of those waves. And I think that's part of it, that, you know, we've gone deep enough now, I think, to kind of break that, because this would have to be a cycle 4, but not a cycle 5 or even lower. So we'd have to, I can go back over that with you, but we'll have to wait because there's still a lot more to go on. So the question was, could this all be, and this is my maximum chart, so let's go all the way back out, that we're still haven't gone up to complete supercycle wave 3. So that we're still working on that. So this would have to be not a cycle 5, would have to be less, cycle 3, and this would have to be cycle 4. But I think coming in, it just doesn't fit. There's other reasons why it didn't fit, but that was the question. Back to what we're talking about, though. So again, we've got on here where this, if indeed the alternate count kicks in. Now, I highly recommend that if you're going to use Elliott, even if you're picking up Elliott from somebody else who's demonstrating it and showing it and analyzing the markets, and you like what their work, hopefully they're showing you both sides. I feel this to be very, very important, even as a day trader, to show both sides of what is possible for the next day. And when I'm going down, I mean, I go all the way down to, like, you know, the small time frames. But if I'm starting on an hourly chart, like I did today, well, let me go back to the ES because we'll actually have labeling. Going back over here, you can see there's my A, there's my B. I'm still working in a C wave. I've left this open because there's just too much still yet to come, I think. And we have that number. And if that's how they reacted to CPI, I'm like, okay, if the PPI comes in much better, or at the same 0.4 or 0.2% better, well, I would expect them to do the same thing all over again. And what's that going to look like? So I'm a day trader. What's that going to look like if I'm short a future, right? And we get one of these moves. In fact, I'm going to show you what this did. I'm going to go back and we're going to look at that thing. Am I going back far enough? No, I have to go back even more. It's not going to happen. I have to go out to my 5-minute, go like that, go like that. And that in one 5-minute, it went from 37.52 up to 38.61. So there you go. In 5 minutes, it was like well over 100 points. And then it just kept going. So in other words, it's like when you're trading on the smaller timeframes, you have to protect yourself, because I'm sure many of you are aware, but in the futures market, every tick in the S&P is equivalent to $12.50. If it moves a point, it's $50. Well, lately the S&P, in the old days, it took a lot of work to get it up $1, because there was so much on the bid and so much on the offer that you had to clear it out and move it up, and clear it up and move it out. Well, that's not the same as it is today. The S&P is more like the NASDAQ at the moment, where it'll jump and it'll fly incredibly. It'll just go, $5. And blink your eyes, it's $5. Well, you got a one lot, $5, $250. How much do you want to really hold on to it? Oh, it's going to come back. It's going to come back. Now it's up 10. Then it's up 15. And we've seen these types of swings. They're not uncommon. So you can blow your account out. So there's a couple of things that I do recommend for day trading, but I'm not going to go into that right now. Let's stick with the Elliott. So I will always give an upside view and what to look for. So what I did leave today in my update was, it's like, if the market, if they approve of that number, if it comes out favorable to how people want to trade, I would suspect that this goes immediately above 4,000, immediately above 34.62, and starts honing in on these upper levels. And then takes a pause. And then we get to look. And then you get to see, okay, what's going on? So much happens, but it can get there real quick. I would imagine all this selling, I don't know if it was just people selling out the longs that they were long on today, and they just wanted to be flat coming into that number. Could have been. I don't know if it was reinstituting short positions in advance of that number. Crazy, but maybe they're doing it. I don't know. But I would suspect a reaction. Now, if the opposite occurs and the market rejects the PPI final demand data and they don't like it, well, then I'm going to think this thing's going to come smashing through. I'll go back out to the hourly, easier to show, right? Right now, we see that it got all the way down. It went through the 50s, these moving averages. If you understand the moving averages, it's like if it breaks this 50, which it got down to, zipped back above, so it's holding. It's holding the 50 EMA on the hourly chart. A break there produces a negative pull, a negative aura, I guess you can call it, around this market. And the general rule would suggest that we would pick up a lot more selling. A break of a 50 period moving average produces a little bit of acceleration in the market in the direction of the break. And the common would be that, well, first of all, we'd probably come down to this, which is fib support, was resistance on the way up, fib support on the way back down, but we're likely heading for the 200 period, hourly 200. And you can see how far down that is. That's almost 100 points down from where that would happen. 90 points. And it can do it real quick. And there's the SMA. That one, I leave it up there because the SMA is one that is followed by a lot of institutions, because that's where a lot of retail, they use the SMAs. So people just keep an eye on them. I think for me, the more important is the EMA, but this one's real. And so right now, it's kind of the flatter one, so it's not believing all of this noise as much as these are. So the longer period is saying, it could come back. So a drop would come there. If it starts breaking here, this is done. Now, let's go out to the daily, and let me start taking these fibs off. so that we can see what's happening. If we get up here, let's just say, maybe we don't, and we just start going down from here, then we're going to be suggesting that the intermediate wave 2 is complete. Now, remember that what I'm trying to demonstrate is the predictive nature. Well, part of that prediction is going to come. We're looking for the completion of an intermediate wave 2. That's the count. An intermediate wave 2. And once that intermediate wave 2 is complete, what am I looking for? An intermediate third wave. Now let's take a quick review of what a third wave consists of according to R.N. Elliott's writing, his work. Third waves are most often the longest and the strongest out of waves 1, 3, and 5 within an impulse move. This is a C wave. It's counted as 1, 2, 3, 4, 5. That's the requirement. It has to have 5 waves to complete a C wave. So coming off in a third wave, I'm looking for 5 waves. I'm looking for 5 waves of minor degree to complete the intermediate third wave. But also within that, I'm looking for that third wave, the minor 3 of intermediate 3, to subdivide in and of itself. Now, one thing that I have picked up over my years of doing Elliott, as we've gotten more electronic and algorithmic controlled, that more than just the third will extend, even within that larger third wave. Wave 1 could extend. And quite often, like right there, that was the first. It was a big wave. Then the 3 extended. So 1 extended, 3 extended, 5 came in normal. So here, what's to say 1 will extend, and that could be the number. That could be the PPI. And then we rally a little bit in a wave 2, and then we start to drop in the third, and it extends. But here's what I can do. We're back here on our extensions. So the only relationship we can really devise now is that we're going to put extensions on for wave 3. And so it's going to be the relationship of wave 3 to wave 1, because those are the 2 impulse waves that we're looking at. And we're going to try to compare to put some parameters around what this wave 3 might look like. So I'm going to say that this wave 4, we're going to use today's high. So let me move that 3 up to here for right now so I can get that. And we're going to use the extensions again. Again, I've got to go from there, down to there, up to there. Now I have the extensions for a possible third wave. Now, if we take a look at this, and let me go back down. I can do a little bit better job on the hourly chart so I can pull it open. We can see from here. So we start to come down. If indeed I've already drawn those because the market's telling me to, well, our first line in the sand support comes at 38.26, and there's only 0.236. So what am I going to consider this third wave? I'm comparing it to the first wave. I'm also now remembering that Elliott's already told me that third waves are most often the longest and the strongest. So if I'm looking in total what this intermediate third wave might look like, I got to go back out. Gosh, I'm going to run out of room. So we're going to open this up a little bit, right? There's wave 1, wave 2, wave 3 is compared to wave 1. Wave 1 was pretty big. Wave 3 would be equal to the length of wave 1 at 3209. We're almost at 4,000. In fact, we were over 4,000 today, 3209. If it turns into that wave 3, now that's acceptable, but it puts a lot of pressure on wave 5 because the other rule that Elliott did give us was that when talking about that, waves 3 are most often the longest and the strongest out of waves 1, 3, and 5. On that same basis, what wave 3 cannot be is the shortest wave out of waves 1, 3, and 5. So if I'm coming down and it comes in right there and it's equal to wave 3, and wave 5 then could likely come in greater than this third wave, but it puts pressure on it not to get too far. So therefore, I always will be hoping that the wave 3 is going to come in longer, greater than wave 1, just in case wave 5 decides it wants to extend. But moving along, so our Fibonacci extensions that we're going to pay attention to are the 100%, 1.618. That's actually most common, that a third wave will come in at 1.618 of wave 1 when you're using the extensions. That's 2709. So I'm like, I've kind of moved it up a little bit, bringing it up into here, because in honest, I'm kind of looking for this whole initial C wave to be done somewhere in this area. So if we're looking like 2200, I'm looking like 24, up a little bit higher. For it to come all the way down to 27, which it can, right? I'm counting 5 waves of intermediate degree. So if wave 3 comes down to here, beautiful. We get a 4 and then a 5, and 5 comes down into here, fits, beautiful, completes the primary C wave, the cycle wave A, and sets the stage, right? This is the beauty of it. If it comes down and finishes a cycle wave A, what comes next? A cycle B wave, a cycle B wave rally. It's going to resemble something like this. It's going to be 3 waves, but it's going to take off, right, like a bat out of hell. Predictive nature of what? Using Elliott and Fibonacci together gives me that look, gives me that thought. And so if I'm counting this thing and they're coming down and I'm a position trader, I am going to be looking to go sell some puts, which will be very expensive, and to buy some calls, which will be very cheap. Because as this thing's coming down, it's going to be coming down in a panic. It's going to be coming down because of something that's happening within our economy, within our government, or with somewhere around the world. All of that is in play now. So when people say, well, what's going to cause it? It's like, pick one. Interest rates, inflation, a bank going belly up. We've had this happen now in crypto, where that young guy, apologized, but he lost. This is the part that blows my mind. He had a $15 billion, or at least a $12 billion nest egg built up from what he was doing, and lost 11 billion of it. And maybe even more, who knows? I'm like, whoa. So when this all starts to give up the ghost, which I do see coming, then would you rather be in front of it or battling it? And so that's a rhetorical question, because obviously our answer is going to be, of course, we want to be with it. So the predictive nature now helps you maybe set up some positions. And because you're going to be setting these up against the narrative that's going on right now in the market. And the narrative in the market right now is like, well, the Fed's going to pivot. Look at the inflation numbers are, hey, not that bad. Inflation's done. As I heard and read, other respected analysts and fund managers actually are coming out and saying, oh yeah, inflation's over. Really? Really? Because of one slight uptick, this is all done? Do they have any concept of why we're in the mess we're in? Folks, I'm just going to start the tip of that iceberg. This rally, do you know what this is due to? The government and the Treasury Department issued $13 trillion of new money that got pumped into the system. Some of it came into us, the grand and glorious citizens of the United States. We got it, but a lot of it went to corporations to keep the companies going and so they could pay their employees. How much of it really got into the employees' hands? I don't know. But that's a lot of money, a lot of money. And that's on top of the $8 trillion that got put into the system in 2009. So that's what we're dealing with. If this doesn't correct, and then on top of that, I just want to just also say that, go take a look at the 10-year note. Take a look at the yield. Take a look at the 30-year bond and take a look at the yield and look at a yield chart. So it topped in 1981. It bottomed in 2022. 40 years. It took 40 years for the interest rates to go from what were they, 18, 19, 20% down to almost zero. Do I really believe that in the 8 months that the whole correction is done and we've taken care of inflation and interest rates are ready to just kind of start cutting them again, guys? Okay, we're all back in business. I doubt it. I doubt it. The reality tells us differently. I do have a chart for the 10-year bond, but I can't remember what the yield chart is going to be. Here was this was the top. So that's the weekly chart. Yes, a lot of damage has been done because this is 4%. This is 0.69. That was the high. If I go over here, you can see it. It's still got room. And maybe not quite as low. Maybe we get back to here. So we're still looking at maybe 5 or 6 or 7% yield on the 10-year note. Yes, I do. I do expect a continued drop in the interest rate, a continued drop in the price of the bond. Right? If you consider that bonds are always par, considered par, which is 100. So if an interest rate is 7%, the bond should be worth 93. If an interest rate is 0.69%, the bond is worth what it was. You can see. And now we get what happens in between. The other thing to understand is that if we just take a look at, it's like everybody thinking, well, the Fed's going to pivot, the Fed's going to stop. It's like, really? I need you to go look at T-bills. Go look at those auctions, which are done every week. That's how the government continues to refund itself. They issue new treasury bills, and us lovely U.S. citizens, we give them our money. They give us the interest. So you've got a 4-week, an 8-week, a 13-week, a 26-week, a 52-week, et cetera, et cetera. So you're really only tying up your money. A 13-week, you're tying it up for 3 months. And if you're tying it up for 3 months, you're getting over 4%. Over 4%. If you're sitting in the market, what's it giving you right now? So it's a nice, safe place. Would I put it in a treasury note? No. But a T-bill, boom, that's what I'm guaranteed. Treasury note, you're only guaranteed if you get in and out. But the whole term of that treasury bill is 13 weeks or 26 weeks or 4 weeks. 4 weeks, I believe, is over 3%. And every single week, they auction all of those off for the next term, I've yet to see those downtick. This they do. Treasuries aren't so openly traded in a market like this. So are they really telling the true story? If I look at this on an Elliott basis, I already put it in. Let me just open this up a little bit, right? Here to here was, I'm on the monthly. If I go down to the weekly, I think I had 5 ways down. 1, 2, 3, 4, 5. We're doing an ABC. Guess what? ABC on there. If I bring it back down again, so again, the predictive nature, ABC, look at that. Here's the daily. There was that high. Here we do 3, 4, 5, right? We get a 1, a 2, a subdivided third, a 4, and a 5. A, B, C. Does it have still upside? Sure. If this is just a wave 2 or a wave 4, because I have to go back and count it all the way down, then what can we expect? What's the most common for a fourth wave? 0.382. So yeah, it could come up to 113. How high did it get? 112. It's just another point. But if they really like that PPI tomorrow, I guarantee you they're going to probably end up here. It would not surprise me, but it fits the pattern. It's not, oh my God, inflation's over. So that's the other thing that I'm trying to talk about. Is we got to keep the noise out so that you can look at it and say, oh, is it going to, so the bonds are going to continue to climb, interest rates are going to continue to come down. And it's like, well, this is telling you different. This is telling you we got that long decline, and now we got this ABC up. And that was last Thursday. Or that day where it just exploded. Short covering. You don't want to be short bonds. I don't know why, but that was the case. The Treasury notes, the T-bill, you're lending your money to the government for a defined period of time. In the Treasury notes, you're buying a 10-year. So, and it's not that you roll it every 4 weeks or every 8 weeks or every 13 weeks. So that's the biggest difference. Yeah, it depends on why you're buying the 10-year note, to be honest with you. And that's a conversation that I don't think we can have right here. But my question would be like, why do you want to buy a 10-year note? Are you that convinced that interest rates are not going to continue to go higher? Because if that's the case, then yeah, you want to get in at a really low price and see if it'll rally back. But what if it doesn't? Where do you want to get out? So what's your trigger to get in? What's your target? And where does the trade become invalidated? And that's your stop. I will share that with you. Yeah, I would too. I hear you on that. But I think there are going to be better ways to put your cash to work. And it might just be Treasury bills. You're not in for that length of time. It's a whole different ballgame. And you just roll it. And you can do it through the iTreasury. You can do it direct as well, Treasury Direct. So no big deal. It's easy to do. All right, so that's in the bond. Let's go back over to our friend, the S&P. So again, the predictability to all of this. And God bless you guys for hanging out with me this afternoon and listening to me. Because I'm hoping this all makes sense, because there's just so much to say and never enough time. So I'm going to try to pull this together. I hopefully been able to, if you can learn how to use it, or you're following somebody that knows how to put all of these pictures together and gives you both sides of the coin, then you get the predictability to it. So again, let's just tie it up by saying, going into tomorrow, we have a major number. We don't know what the reaction is going to be. Would you like to have an idea of what if the market does this? What does that suggest? What if the market does that? What does that suggest? And that's what I'm just doing for you. I'm counting a C wave up. It consists of 5 waves. At best, I have finished 3, I got a 4, and I've got a 5. And if that's the case, I've already gone out, and I'll put them back up there. I want wave 1, and that's going to be, let me remove that guy. Up to this top, down to that bottom, up to, no, I'm sorry. I'm looking for the C wave, right? So I'm going to go this way. A, B, and there's our C wave. So we already know that we could still get a 5th wave, and we've got 40-30, we got 41-20. as high as 42.18. I'd like to know that ahead of time, if it's because I'm going to be watching the reaction. And instead of going on, well, this is what they did last week, or this is what the pundits are saying, this is what this is saying. No, go in with your own thought and keep your head clear of what everybody else thinks. And just have your points of where you're going to trade. What I also can do is we have that one, and I'm going to add, let's go add one more. I'm going to bring this back down to the hourly chart. Then I'm going to start to wrap it up. If again, this is 3 and then we got a 4, and again, I'm just going to go this route because those are the points that I already have in place. So I'm not second guessing it. They may be adjustable. I'll put it down here. All right, so let's see if we got a little bit of overlap at 4,030. Our next overlap, and what I mean by overlap is like I got 2 points, 2 Fibonacci points coming in at the same area. It gives a little bit more strength to that point. So right now I got 100% of where minor wave C would be equal to minor wave A right there at 41.20. And guess what I got right behind it at 41.33? I have where wave 5 of C would be equal to 0.618 of wave 3. I was like, okay, that all fits. That all fits. So now you got that. And where else do we get it? And the next one is 1.236, which again, 42.22. If they really love that number and they really start tackling it all down again, well, now you got a double resistance point right there. And then a third, just a little bit higher. So when you start to see the overlap, it starts to give a little bit more strength to that level of resistance, level of resistances right there. So predictability, yes. A predictive nature, yes. You're going to find people forever that are going to tell you it has no predictive. It's crap. It depends on what you're looking at. I'm looking at this on an hourly chart. The same thing can happen on a 15-minute chart or on a 5-minute chart. But guess what? If I'm using a 5-minute chart, the reality of it is that your picture can change every 5 minutes. And that's important to bear in mind. On your hourly chart, it can change every hour. So you give yourself a little bit more wiggle room, so to speak. But if I'm going to come down, all the way down, it's the same principle that continues to work. You're counting 5 waves up or 5 waves down, followed by 3-wave correction, and they're building blocks. And what happens on a 5-minute chart produces what happens on the 15, vice versa, all the way out to your monthly max. So this all works. It really does. But you have to be consistent. Do not break the rules. It's just like I tell people about your trading. Have your trading rules and respect your trading rules. Because most people, they want to come in, they want to make trading their livelihood. They want this to be the paycheck. And it is very possible, folks. It really is possible. But it's not if you don't have trading rules. If you just kind of come in without any real idea about what you're doing and how you're going to go about it. So some people coming in with 5,000, some people come in with 10,000, some people come in with 100,000. Those are decent size accounts. But if you're coming in to trade a market that can take all of that in one foul swoop, how do you want to trade it? So you want to know what's your trigger to enter a long or short position. What's the target of that long or short position? And last, where does that trade? At what point does that trade become invalidated? And therefore, that's your stop, because the market is not going to do what you felt when you entered the trade. People tend to not do that last step. And then they talk themselves out of actually taking the loss. Now, I'll leave you with this. Taking the loss clears your mind away from, oh my God, I'm stuck. What am I going to do? You get out of the position. When you start into this mindset of it's going to come back, I'm just going to wait, it's going to come back. Or what happens? I get out and then it comes right back to what I thought it was going to do. What would stop you from re-entering another trade? You're afraid to get out of the trade because it's going to do what you think it should do. But because you're afraid to get out of the trade, it continues to go in the direction that is hurting you. And now you're even doubling down on like, it's got to come back. It's got to come back. Meanwhile, if you took the loss, if you had to stop in at a position where the trade wasn't invalidated, that gives you an opportunity to stop, take a look, like, oh, I don't want to be short. I want to be long. You re-enter the market, you make up what you lost, and then some. Having your own rules are very important, and they're very important to honor. Of wave 3, 1.618. But I think anything over 1%, you can start going 1, 2, 3, 6, 1, 3, 8, 2. You can use those as well. But the one that I kind of stick by and then I look for is 1.618. And the question is that concerning a third wave, roughly what proportion would I say that will extend to? Is it 1% or 1.236% or 1.382% or 1.618%? I normally will go for the 1.618%, but here's the catch. More important than the Fibonacci are the wave pattern itself. If I'm looking at a third wave, whether it's up or down, I'm looking at a third wave. What is inside that? 5 waves. The third wave will consist of 5 waves in and of itself. And normally within that third wave, the third of the third will break down into its own 5. And if we were just listening to what I was saying, is that I'm finding now where wave 1 can be extended and wave 3 can be extended. So you're getting into a position where how you count that, make sure you count them right, that you don't break your rules, and that, oh, good, I'm not sure what that was, so that it works for you, and that what you're seeing and where you're putting stops and where you're putting entries are going to make better sense. So I'm going to kind of leave it open now for some questions. I know I only really went over the S&P, but that seems to be everybody's favorite market. Yes. Okay. The question or the comment is that often on a daily, I can count 5 waves up as an impulse and look at it pretty easily. But on the hourly, it can look like a mess or even a diagonal. And that is very, very true. So that's why you constantly are balancing yourself, looking at a daily, looking at the hourly, and maybe even looking underneath, because sometimes that mess can clear itself up when you go and you look inside the mess to see what actually formed that doesn't show as clearly on that hourly, but maybe it will on a 30-minute chart or even a 15-minute chart. So, and again, you could be looking at your daily and it's looking like it's a clean 5, but when I break it down and I look at the hourly chart or even the 4-hourly chart, I'm seeing some overlap here and there. So it may not be that clean 5. Maybe it really is an ABC. Now this I've run across. So again, yes, the sum up the question or just the comment, you always want to be reinforcing what your thoughts are, reinforcing what your count is by confirming on the daily, confirming on the hourly, making sure that everything fits. Part of what Elliott did teach us, or does teach us, is that you have the structure, right? Impulse. I'm telling you, I don't use WXY. A lot of people do. I do not. But there have been more diagonals lately. And that I'm finding kind of very interesting. It doesn't make them right. It doesn't make them wrong. It just means right now we're seeing a lot of diagonals. And you're right. I don't like them either. That was good. But WXY is more of this harmonic Elliott wave, and I don't like it being called Elliott wave. And I'm a purist, so please forgive me. I think it's harmonic, but I don't agree that it's Elliott, because Elliott was very clear. These are the rules, these are the guidelines. Don't break them and use the guidelines. Nothing about, that we're going to add. And I know Robert Prechter and a lot of people in his office and his group use WXY. They've switched over, and maybe I will at some point, but I don't like how they're extensively used. And so we're counting a 5-wave structure that's all threes, which only really happens if it's in a triangle pattern, a C wave within a triangle pattern. So just as a straight impulse, counting it as all threes, no. Diagonal, yeah, you could. But standalone, no. So that's why I don't necessarily do that. But I'm actually going to finish up here, folks, because I've been talking for a long time. And I really appreciate you hanging out with me and hearing what I got to say. I will say that you can reach me if you have questions or if you want any additional information about what I do or what I may offer. Please send me an email at michael@mjf1partners.com. I always answer my emails. If you're actually asking a question, I will always answer. Also, you can go to tradershelpingtraders.com, and from there you can look towards logical signals. And on the logical signal site, you will find my podcasts, and you will find my daily posts, which I cover the NASDAQ and the S&P. And podcasts, I'm now bringing in guests. One was just here today, and you probably listened to her, Sunny Harris. I adore Sunny. I respect her work tremendously. And also earlier this morning was another person that's been a fan with David's work, and it's Wally Olipod, excuse me. It's a difficult name, and it should be easy to say, but I had a little trouble there. Wally is another amazing analyst, and I respect his work. So I'm putting together podcasts so we can discuss, and they can give their background, and we can talk about what they do, et cetera, et cetera. So all of this you can find through tradershelpingtraders.com or logicalsignals.com. And David, thank you so much for letting me to use that extra time, because as you can tell, I filled it pretty easily. I'm going to turn